China's massive sell-off of US Treasury bonds could be the first domino in destabilizing the global economy. Let's delve into how China's strategic financial maneuvers could influence the future of the US economy and the dollar's stability. What would happen if China continues to divest from US debt at an accelerated pace? Make sure to stick around as we unpack the potential impacts and explore what lies ahead. In this video, we examine China's decrease in US Treasury holdings, delving into its historical background, underlying motivations, future prospects, and the potential effects on the US economy and the value of the US dollar. China's substantial accumulation of US Treasury securities began in the early 2000s, propelled by its rapid economic expansion and significant trade surpluses with the United States. During this period, China exported vast quantities of goods to the US, leading to a substantial inflow of dollars. To manage these funds effectively, China made substantial investments in US Treasuries, which were considered secure and easily convertible assets. This approach not only enabled China to generate returns on its reserves, but also reinforced the stability of its own currency by maintaining a favorable exchange rate with the dollar. During this period, China's foreign exchange reserves experienced rapid growth, exceeding $1 trillion by 2006. The accumulation of US Treasuries served as a method to reinvest trade surpluses into the US economy. This approach also fulfilled the US government's borrowing requirements and bolstered the global demand for US debt. China's holdings of US Treasuries reached their apex around 2013, surpassing $1.3 trillion. This peak formed part of a broader strategy to manage its extensive foreign exchange reserves, which had ballooned to over $4 trillion, the largest globally at that time. As China's economic influence has grown, so has its role in global financial governance. Historically, China has used its vast reserves to wield soft power on an international scale, notably during the 2008 global financial crisis, when it positioned itself as a stabilizer in the volatile market. This strategic positioning has allowed China to negotiate trade terms favorably and increase its voting rights and influence within international financial institutions like the International Monetary Fund, IMF, and the World Bank. This pinnacle reflected China's confidence in US Treasuries as a secure and dependable investment amid global economic uncertainties. At its zenith, China emerged as the principal foreign holder of US debt, surpassing Japan. This substantial ownership underscored China's role as a major financier for US government fiscal operations, which contributed to maintaining low interest rates. By the mid-2010s, China initiated a shift towards diversifying its foreign exchange reserves, driven by several factors. Firstly, there was economic rebalancing. China aimed to lessen its reliance on exports and stimulate domestic consumption, altering the flow of dollars into the country and necessitating a more varied reserve strategy. Secondly, geopolitical tensions, particularly with the US concerning trade, technology, and regional security, led China to decrease its exposure to US financial assets. The potential for US financial sanctions and other economic responses also influenced this strategic shift. Lastly, concerns about risk management arose due to uncertainties surrounding the stability and value of the US dollar, exacerbated by substantial US fiscal deficits and monetary easing policies, prompting China to adopt a more cautious approach through diversification. Consequently, China began increasing investments in alternative assets such as gold, euros, and Japanese government bonds. Over recent years, China's holdings of US Treasuries have steadily diminished. For example, between 2017 and 2018, China reduced its holdings by approximately $100 billion. This trend has continued with notable monthly reductions, culminating in a record sale of $53.3 billion in the first quarter of 2024. This reduction signifies a strategic shift towards more flexible management of foreign reserves and a reduced dependency on US debt. In addition to financial investments, China's strategic maneuvers include enhancing its physical assets, specifically in critical infrastructure across the globe through initiatives like the Belt and Road Initiative, BRI. This includes investments in ports, railways, and highways that extend China's reach into Europe, Asia, and Africa. These assets not only provide China with leverage in international trade, but also serve as collateral and security in financial operations, further reducing reliance on traditional financial instruments like US Treasuries. Regarding monthly sales data, Recent reports show that China has consistently decreased its holdings of US Treasury bonds. For instance, in June 2023, China sold $9.3 billion worth of US Treasury bonds. This ongoing trend clearly indicates China's intention to diversify its reserves and reduce risks associated with its substantial exposure to US assets. Strategic implications. The reduction in U.S. Treasury holdings forms part of a broader strategy by China to shield itself from potential U.S. economic sanctions and financial pressures. By diversifying into assets like gold, euros, and Japanese government bonds, China seeks to safeguard its reserves against geopolitical risks and bolster financial stability. This approach also aims to mitigate the potential impact of conflicts or sanctions stemming from the strained U.S.-China relationship. Diversification into other assets. China has expanded its investments in various asset classes, including gold and Japanese government bonds. This strategy aims to diversify risk and decrease reliance on U.S. dollar-denominated assets. Comparison with Japan. Throughout the 2000s and 2010s, Japan and China competed for the title of the largest foreign holder of U.S. Treasuries. According to the latest data, Japan currently holds this position, signaling a shift in the global financial landscape. This development underscores China's strategic adaptations and ongoing efforts to diversify its reserves amid evolving economic and geopolitical circumstances. Japan's stable economic environment and strong alignment with the U.S. make it a less contentious holder of U.S. debt compared to China. This shift highlights the evolving dynamics in global financial markets, where major economies are adjusting their investment strategies to manage risks and leverage emerging opportunities. China's investment strategy involves reinvesting in various asset classes. Here's a detailed breakdown of where China is directing its investments. 1. Support for the yuan. A substantial portion of the funds obtained from selling U.S. Treasuries is allocated to support the yuan. This includes purchasing yuan on the global market, which helps stabilize and potentially enhance the value of the Chinese currency. This initiative holds particular significance for China amidst ongoing economic and geopolitical tensions with the U.S., aiming to uphold the stability of its currency. 2. Diversification into other assets. China is diversifying its foreign exchange reserves by investing in alternative assets such as gold and Japanese government bonds. This diversification forms part of a broader strategy to diminish dependence on U.S. dollar-denominated assets. Notably, China has significantly augmented its holdings of Japanese government bonds in recent years, contributing to its diversified reserve portfolio. 3. Investment in European bonds and other securities. China is also turning its attention to European assets, including sovereign bonds denominated in euros. This strategic move is aimed at diversifying its foreign reserves and mitigating risks associated with holding an excessive amount of U.S. Treasuries. 4. Strategic economic adjustments. In addition to diversifying asset classes, China's overarching strategy involves gradually reducing its holdings of U.S. debt. This approach seeks to mitigate potential risks stemming from U.S. financial policies and geopolitical developments. It reflects concerns about potential U.S. sanctions and aligns with broader efforts towards dollarization, aiming to lessen dependence on the U.S. dollar in global trade and finance. China's ongoing reduction of its U.S. Treasury holdings marks a significant shift in global financial dynamics, with potential far-reaching consequences for the U.S. economy and the world at large. As we've explored, this strategic move is not just about diversification, but also a careful recalibration in response to evolving economic policies and geopolitical tensions. The implications of these changes are profound, and keeping an eye on these developments is crucial. What do you think will be the long-term effects of China reducing its U.S. Treasury holdings on the global economy? Feel free to share your insights and opinions in the comments section below. Don't forget to join our Revel Discovery community by clicking the subscribe button to stay updated on the latest economic trends and shifts. Dive into the complex world of international finance and understand the future implications of these monumental changes.